In 72 hours, gold lost over $1,000 an ounce. CNN called it the worst week since 1983. Every financial headline said the same thing, that it was just the market correcting. It wasn't a correction, it was a controlled demolition. And by the time you understand who lit the fuse, you'll never look at your portfolio the same way again. Let's go back to January. Gold had just hit $5,589 an ounce, an all-time record. Every analyst on Earth was calling for 10,000. Pension funds were piling in. Central banks had been buying at the fastest pace in 50 years. The narrative was bulletproof. Gold was the safe haven, the only asset that could survive what was coming. So what happened between January and now? What flipped the switch? 3 things happened, and none of them were accidents. First, the Federal Reserve made a very deliberate choice. In their March statement, they cut their rate projection from 2 cuts in 2026 down to 1. One single cut. That might sound like a minor adjustment, but in the gold market, it was a nuclear bomb. Gold is a non-yielding asset. It pays no interest. When rates stay high, the opportunity cost of holding gold skyrockets, and capital flows out. The Fed knew exactly what that announcement would do. They've seen it before, they engineered it before. The 10-year Treasury yield jumped to 4.2%. The dollar index climbed toward 100. And gold, the so-called safe haven, cratered. $1,000 per ounce, gone. Not over months, over days. But here's where it gets strange. Because at the exact same moment gold was crashing, something else was happening that should have sent gold through the roof. War. Real war. The United States and Israel launched strikes on Iran, now in their 3rd consecutive week. The Strait of Hormuz, the choke point for 20% of the world's oil supply, was actively disrupted. Brent crude surged past $108 a barrel, a 40% spike from the start of the year. In every textbook, in every financial model, war plus energy crisis equals gold to the moon. That's the trade, that's how it's always worked. 1979, the Iranian Revolution, gold tripled. 2008, financial collapse, gold doubled. Every single time the world burns, gold rises. Except this time, it didn't. Gold didn't just fail to rise during a shooting war. It collapsed. Ask yourself why. Because this wasn't the market reacting. This was the market being directed. On March 16th, the London Metal Exchange, the oldest and most important commodities exchange on Earth, halted all electronic trading for nearly 3 hours. All contracts, copper, aluminium, zinc, nickel, tin, everything frozen. They blamed it on a technical issue with their matching engine. A technical issue during the worst commodities sell-off in decades, during an active war in the Middle East. At the exact moment when the paper price of metals was diverging wildly from physical reality. That's one hell of a coincidence. And this is not the first time. In 2022, the LME halted nickel trading for an entire week after prices doubled overnight. They canceled billions of dollars in legitimate trades to protect a single Chinese billionaire who had made a bad bet. The exchange exists to serve the interests of its members, not the market. Remember that. Here's what that halt really means. The paper gold market and the physical gold market are 2 completely different animals. On the paper side, banks and hedge funds trade futures contracts, bets on where the price will go. Most of these contracts never settle in physical metal. They're just numbers on a screen. And when the big players want to crash the price, they dump paper contracts by the thousands, flooding the market with sell orders that have nothing to do with actual gold changing hands. The physical market tells a completely different story. Try buying a gold bar right now. Good luck. Premiums over spot price have exploded. Delivery times are stretching to weeks. The Royal Canadian Mint, the Perth Mint, they're all reporting demand surges even as the paper price tanks. The price you see on CNBC is not the price of gold. It's the price of a promise, and promises can be manipulated. So who benefits from crashing gold? This is the question nobody on financial television will ask. And the answer might be the most important thing you hear this year. Follow the money. In February, the United States officially established the Strategic Bitcoin Reserve, Executive Order, federal level. The government began accumulating Bitcoin as a strategic national asset alongside gold, alongside oil. For the first time in history, a sovereign nation declared a digital asset worthy of treasury-level reserves. Now think about the timing. Gold crashes, Bitcoin halts. The government has been quietly acquiring Bitcoin while simultaneously taking actions that suppress the price of gold. Rate hikes kill gold. Paper manipulation kills gold, but Bitcoin doesn't care about interest rates. Bitcoin doesn't trade on the London Metal Exchange. Bitcoin can't be frozen by a convenient technical glitch. There's a theory circulating on Wall Street that the United States is executing a rotation out of gold into Bitcoin. Pump gold to record highs, let institutions and foreign governments buy at the top, then crash it, use the liquidity dislocation to acquire Bitcoin at suppressed prices before the next leg up. It sounds conspiratorial, except that every single piece of it is happening in plain sight. And here's the part that should genuinely concern you. The same institutions that control the paper gold market, the same banks that sit on the London Metal Exchange Board, the same Federal Reserve that just chose to keep rates high, they're the ones buying Bitcoin. BlackRock, Fidelity, Goldman Sachs, JP Morgan, all of them now have Bitcoin products. All of them have been accumulating. They told you Bitcoin was worthless for a decade, and now they own more of it than almost anyone. If you hold paper gold, an ETF, a futures contract, a gold-backed fund, understand something. Your gold might not exist. The paper-to-physical ratio in the gold market is estimated at more than 100 to 1. That means for every 1 ounce of physical gold, there are over 100 ounces of paper claims. When the music stops, 99 out of 100 shares disappear. This is not the first time they've done this. In 1933, the United States government confiscated private gold holdings. Executive Order 6102. They paid citizens $20.67 per ounce, then immediately revalued gold to $35. A 40% wealth transfer, overnight from the people to the state. The playbook hasn't changed, only the tools have. This is not about gold versus Bitcoin. Both are sound money. Both exist outside the control of central banks, at least in their physical and self-custodied forms. This is about understanding the game that's being played with your wealth while you're distracted by headlines about war and inflation and interest rates. The gold crash was not random. The timing was not coincidental. The LME halt was not a glitch. And the Federal Reserve's decision to hold rates high, while every other economic indicator screams for cuts, was not about fighting inflation. It was about repositioning. The biggest wealth transfer in modern history is happening right now, not tomorrow, not next year, right now. Assets are moving from people who trust the paper system to people who understand that the paper system is the product being sold to you. Gold at 5,500 was the top they manufactured. Gold at 4,500 is the panic they engineered. And what comes next? The recovery, the rotation, the new monetary architecture. That's the part they don't want you positioned for. So here's what you do. You stop trusting the ticker. You hold physical, not paper. You diversify into assets they can't freeze, can't dilute, and can't halt trading on with a convenient server crash. You understand that in a rigged game, the only winning move is to stop playing by the rules. Gold didn't crash, it was crashed. And now you know who did it and why. The question is what you do with that knowledge before the next move happens.